I recently had the opportunity to speak with Jeremy Lefebvre from the Financial Education YouTube channel. The last time he was on the channel, we only had one fintech company in common, PayPal stock. During that conversation, I actually pitched Jeremy on a potential new opportunity called SoFi Technologies. And it actually didn't go through. He didn't like how the company was making no real GAAP income. But many months later, and SoFi continuing to grow and actually breaking GAAP profitability, Jeremy has come back on the show to talk about not one, but two companies that we have in common in the fintech space, PayPal and SoFi Technologies. But without further ado, please enjoy the conversation. Jeremy Lefebvre.
Yes, I'm
How
here.
you doing, buddy?
Doing very well, thank you. Doing very well. I can't complain about much.
So we now have two companies in common that we're going to be talking about today. Finally, last time it was one. We were talking about PayPal, but I also want to talk to you about SoFi because since the time that I had pitched you on this company, you said that you wanted to wait till earnings and see some actual real profits. That happened, and you were true to your word. You ended up joining in on this company.
Yep. It's official. 2,000 shares deep so far. So might take it up to 10,000 shares. We'll see.
Gotcha.
Yeah, I'm thinking going 5,000, but I like what I see, and I'm sure we're going to get into this. We're going to talk the numbers, but I'm liking what I'm seeing with SoFi, and man, have things changed over the past year or two on that company. It's been pretty amazing.
Yeah.
Huge.
So let's just jump right into SoFi. We'll start there. SoFi valuations have come way down. Revenues, margins, profits, all increasing. Yet the stock price not moving too much, only at $8 per share. Why was the exact reason that you pulled this trigger? Is it a combination of valuation, their product? What did you really like?
I like that a lot of things, to be honest. One is obviously their revenue growth is incredible. I mean, you look out at fintech, you look out at even like if you want to put them in the category of banks, I mean, who else is really putting up those sorts of growth rates, especially, in North America? I mean, that's insane. So the growth rates are incredible. The fact that they are flipping to operating income now from, you go back just 5 quarters ago, massive operating losses. Big change there, big change in the bottom line. And then also you look at the valuation, and this company, if analysts are right about their estimates for next year, for 2025, company's trading about 34 times next year's numbers, right?
Right.
For a company that is growing at the pace of SoFi, I think it's a very low valuation considering the top line growth, and then the bottom line growth is going to be a lot more extreme than the top line growth. So for every dollar they bring in extra revenue over this next year or two, I think a lot more of that dollar is going to hit down that bottom line. And so I think there's a between valuation, the growth rates, and then the last component I would say is you look at that stock price, it's obviously down massively from where it was in 2020, 2021, let's just say 2021, years ago, right? And you think about where the business was, let's say in 2021, when the stock price was, $20, $30 a share or whatever, versus where the company is today, it's like a night and day difference in terms of the revenue rates, in terms of operating income, net income. And so it's a pretty fascinating time period where you're getting the stock price that is so defeated for a company that, if anything, they've just gotten stronger and stronger over the past 3 years. So yeah, all those components made me say, let me jump on board.
So I want to show you something because I saw that slide that you sent me. I thought that was great about what management is, or sorry, not even management, what analysts are suspecting for 2025. And in particular, what I wanted to circle on that was what they're expecting for 2026. And the reason why I'm going that far out is because Anthony Noto was very particular that they have set guidance for 2026. And so I want to show you that 2026, you saw all the analysts, I think it was over 10 analysts had put it on an average of 52 cents EPS in 2026, 52 cents, which placed them at a PE ratio of 13x, right? Something like that, 13, 14x.
Yeah, very low.
Anthony Noto himself and management had posted that they believe they're going to get to 55 to 80 cent EPS by 2026, even though, Wall Street is calling their bluff and saying they are going to go below estimates here. I wanted to show you a slide real quick. I've probably shown this to you before, but it just furthers with this extra quarter. Maybe I can even blow it up a little bit. So what we can see here is revenue expectations versus what they actually put out, the dollar beat, and then the percent change that we're seeing. And then same thing for EBITDA. Okay. We can see that every single quarter, they've beaten on earnings and expectations every single time. It's hard as a company, at least in my opinion. I hope that you look at this the same way. And if you don't, let's talk about it. But for a company that has beaten guidance on both top and bottom every single quarter, even expecting 2026 to be under 55 cents, their low side of guidance, is just mind blowing to me.
100%. Yeah. I mean, there's very few companies that you can count on quarter in, quarter out beaten. And SoFi seems like it's really emerged as one of those companies that it's so comforting as a shareholder, right? You go into an earnings and you feel excited instead of like, crap, they're going to miss. I'm scared. Like, you know, I don't know what's going to happen here. And the stock price hasn't reflected this kind of, you know, impressive streak the management team's been on. So I think you bring up a great point there. And I think over time, it's all going to play out. My perspective is I think Wall Street's just paranoid about a recession, a big recession, unemployment going up, what that would do to SoFi's business model, what that would do to SoFi's revenues if they would start taking losses. And if they did start taking losses, how big the losses would be. But, you know, we've seen SoFi take massive losses obviously over the years. It's not like this is JP Morgan that's been profitable for like 100 years now, and to take a loss would be, you know, I could never imagine that. SoFi, this company's been through huge losses. So even if the big one hit, big recession, oh my gosh, SoFi's proved in the past it can weather, you know, even huge losses on the bottom line. So I don't know, you know, what do you? I would love to hear your perspective on what do you think is going on with the share price? Like, why is this company able to put up these numbers, and you know, why is Wall Street not giving any love? Because you've been a SoFi shareholder for a bit, so I'd love to hear your perspective on that.
So, one, I think that people compare this company to other businesses in other sectors like Palantir, for example, which are putting up similar revenue rates and even guidances. And yet they're getting an exceptional valuation versus SoFi. The difference is that SoFi has real risk on their balance sheet, a ton of loans that can turn over in a blink of an eye. And that's very different than a Palantir or something that might just lose a contract, right? So I think that banks and financial institutions will always have that valuation compression because there's a risk of macro turning around, which could not only flip over their growth rates, but also take them into a negative territory. So there's that. And then there's also the idea of how can you compare SoFi to other players in their industry? So the one company that I continuously go back to, and I should probably stop at this point because SoFi is shown that they're nothing like them. But I do honestly believe most of the analysts that cover SoFi also cover another company called Lending Club, ticker symbol LC. And this company does the exact same business that SoFi does. They have a nationally chartered bank license. They're fully digital. They deal mostly in personal loans. They take in deposits from their checking accounts. That is SoFi's business. And yet this company has underperformed, said there's a terrible macro environment, has stated that it's extremely hard to sell loans and perform in this business, and 2023 was exceptionally bad for them. And yet during that time, SoFi has outperformed, sold loans, completely turned over their business and hit new highs. And I honestly believe, in my heart of hearts, analysts continue to look back at comparables and say, all these companies are struggling. SoFi is going to find themselves in a struggling environment as well. And it's just not happening right now. So my opinion is that as macro changes, SoFi should get an exceptional valuation. Like, they should be probably seeing some sort of level of execution credit, right? For being able to beat expectations so much. We just haven't seen it yet. And it might even be too early.
Let me ask you this question, because now that getting into the community more, I've seen also some conspiracy theories.
Sure.
And I'm sure you've probably heard this conspiracy theory, and I would like to know if you feel like this has some merit. But there's a theory out there that, obviously a lot of the analysts work for big banks. There's a theory that a lot of the analysts are trying to hurt SoFi, keep SoFi stock down, make people not excited about SoFi. What are your kind of thoughts on that theory that's out there?
I've only felt that one time.
One
One time. I don't think that analysts, although, so I'm in, the financial space, work full time. Analysts, although working for the company, really do work for themselves. They want to have the best portfolio so then they can continue to get new job offerings and raises and all these things. To completely trash their portfolio by saying, a company will underperform, even if they are potentially going to outperform, is going to look really bad on their performance. And by the way, all the naysayers of SoFi have been continuously seeing downgrades on their ratings because they've been wrong on SoFi so far. But that being said, the only time I've ever felt like there was anything that seemed fishy was a company called KBW that came out and said that SoFi will underperform because their stock price has gone too high. And so that's why they think that the company's real underlying performance would deteriorate. They also said things like interest rates being cut would be bad for SoFi's business. Anyone in the banking space knows this not to be true. Okay. It's actually quite the opposite. And yet they still put that out as the factor for the reason for the company coming down. And that call came out before Jay Powell spoke and all this stuff. And the stock fell like 15% when the short interest was at its absolute highest. And it all just kind of conglomerated into something seems fishy here. But even then, I'm probably wrong. It just seemed a little too perfect. But yeah. I don't know.
Do you remember SoFi's revenue growth rate off the top of your head from this last quarter? I think it was like high 20s or low 30s, but I can't remember the specific number for SoFi.
Revenue?
For revenue, yeah.
34%.
34.
For adjusted, 35 without adjustment. Yeah.
Okay. So yeah, and the way I also think about this, to take it back to valuation, right, is so let's say analysts are right about 2025 numbers, and so the stock's trading at, a 34 forward P right now, right?
Yeah.
If you're looking at 2025 numbers, the other big banks, traditional banks, probably are 10, let's call it 10 to 11. So we can say SoFi is trading at maybe 3x their, forward Ps based upon 2025 numbers. What's fascinating about that is SoFi is growing their revenue, we can call it somewhere between 5x and 10x the average bank.
Sure.
So, a 3x valuation on a 5x to 10x growth rate versus other banks, if anything, that smells like, undervaluation, in my personal opinion. Because if you're going to compare them to other big banks, it's just like other big banks aren't growing remotely close to the way SoFi's growing their business. And so I think that's another easy way for investors to kind of think about the valuation, concerns.
And I think, honestly, a lot of these banking guys are coming in with traditional metrics to try to compare to SoFi, right? With a lot of these banks, what they focus on, like any other company, you want investors to focus on the things that are doing well, not the things that are doing poorly. And so banks have really taught their investors to say, hey, don't look at our customer counts. These don't matter. Don't look at revenue growths. These don't matter. Look at our return on equity. Okay.
Yeah.
Look at our our return on invested capital. Look at all of these metrics. And whenever you look at SoFi that way, they're so not mature. They don't have the teams to do so. It's not even their real goal. And so their return on equity is much, much lower. It's like in the low teens, I think, versus other large banks that are doing 20 plus, some of the smaller institutions doing 30 plus. It's like, it's not even close. So if you are looking at it as a bank, SoFi just seems like an underperforming bank. The problem that I always think of is every single member of a company in these banks are little revenue compounders, right? As they get more products, as they spend money, as they, use the brokerage apps and get personal loans, they're continuing to give SoFi money, even though they paid for them once. And yet the customer base continues to grow larger and larger and larger. And they're expecting by the end of 2024, they're going to be at 10 million users. I think JP Morgan's at 80 million or something. So it's like not even, too far off. And that's not only on the consumer banking side, right? I'm not saying, SoFi's 1/8 of JP Morgan or anything. They have so many other global sides of the business, but to be a real disruptor, you have to find one area that you can grow in market share. And SoFi is taking market share in every single product category that they have across the board. For their debt monitoring, for their personal loans, for their student loans, for their home loans, they're taking it in every single product. And so as that goes on and these companies are losing deposits, it's like, okay, return on equity is only how much you can build with what you have. If what you have is shrinking, you're not going to have much at the end of the day. So I honestly think it's just a matter of how you're valuing this company. And I think they're wrong.
100%. Yeah. And, for SoFi, one of the ways I look at it, they should be fully focused on trying to grab Gen Z, trying to grab even Gen Alpha as Gen Alpha ages over the next few years.
Sure.
And, they kind of, because I remember, JP Morgan Chase, when I was ready to set up a bank account, they had an offer. I think we got it in the mail at that time. And it was, $250 bonus if you set up direct deposit for 90 days. And so I need to set up a bank account, and I did, right, with Chase. And I've been with Chase ever since. And now I'm like in their private bank or private client services or whatever it's called. And still to this day, I'm loyal to them and I still use them. And so SoFi is going to have trouble getting me as a full-time customer. They might be able to get me for a product here or there, but it's like that if you can get those people when they're young, 17, 18, 19, 20, and those people's wealth obviously builds over the years and years, you see the fruits of your labor come over the coming years. And that's like you spoke about with user metrics. I think that's really important because let's imagine these old school banks, let's say you attract a lot of baby boomers, and as baby boomers age, they, eventually pass on. So you lost a customer there. But then SoFi is getting the next generation of customers. And so their wealth grows. And the next thing you know, SoFi becomes a giant over the next 10, 20 years, right?
Right.
Assuming they can make it through all different recessions and things like that, which, let's talk about the boogeyman. I'd love to hear your perspective on this. The boogeyman in the room is a big recession. How do you feel Noto could, do you have a lot of confidence in Noto weathering, let's say, a 8% to 10% unemployment type recession? Do you feel like the company, let's say that happens 2 years from now, do you think the company could weather that storm? What makes you confident that I would love to, kind of hear your opinion on that.
I mean, I'm not of the belief that there's going to be a terrible macro environment. So let me frame that. But I mean, I think that they've gone through extremely hard times. The great thing about being a bank that SoFi is right now is they have so many levers. And so they're even pricing in for 2024, 5% unemployment, which is even more conservative than the average estimates, probably around 4.4% for the year. But yeah, they would just scale down their lending business and focus on things that have less risk on their side. So even that's kind of what pulled the stock back a little bit. Their guidance for 2024 was much slower lending growth. They even said it would be contracting. But that's because they believe that there's going to be a worse macro environment. If that continues to push in that direction, even past their expectations, I just think that they would put that segment on a pause. We would find it hard to grow from a revenue perspective, but that would be the entire market would be like, it would just be full recession. Find the company that's the least loser. I'm not really trying to look for hyperscalers at that point.
But no, well put. Because I mean, I think a lot of it goes back to, the belief in the big dog, the boss, right? In JP Morgan's always had Jamie Dimon. So there's just a belief that Jamie Dimon's going to get through it. He's got this under control.
Sure.
And so, if there's a belief that you feel like Anthony Noto, like he's got it, I think that's a really good sign. Overall, I'd say that.
So the one thing that is good yet bad for SoFi is that they have a lot of unsecured personal loans. And that puts them in a worse environment than other banks because they're unsecured and there's they can kind of just say, hey, I'm done paying. Can't afford it. Sorry. Come chase me. Yeah. But in the same breath, it also means that the loans that we give out have extremely low life of loans, which means that by the time people pull out a personal loan, by the time they finish the loan is probably about 18 months. It's roughly the average for the life of loan for personal loans at SoFi. So it also means that depending on how long out that this problem might start occurring, that SoFi has sometimes can get a lot of things off the books by that point. Whereas it's the big problem with a lot of the regional bank runs and stuff like this is that they have such low interest rates on very long-standing loans. And so they're stuck with this environment where their cost of funding is rising so fast, but yet they have such a mature book that they can't really get rid of. SoFi has a little bit of problem with that because of student loans. They're much longer dated. They can be, 10 to 20 years. But it also makes up for a much lower percentage of the overall book that SoFi has. Most of their loans are actually, quite new. And so very high coupon rates and actually holding up decent on on defaults. So
tell me if you think this is accurate, because as a new SoFi investor here, I'm getting the sense that management team doesn't care as much about the student loan business moving forward. Do you get that sense as well?
So I think that in this environment, the rate that you would get from the government directly versus what you could get at SoFi is almost like SoFi can't price it to be profitable, right? So they don't necessarily want student loans nearly as much as they want personal loans because they're higher coupon rates. And if you raise it high enough, then people will just say, screw it, I'll stay with the government. Like they're a fine lender. So, if interest rates continue to climb, that's going to bring up their cost of funding across the board. And if, the government is not raising their interest rates too much, there's only so much room that you can play with. And that's getting extremely tight right now. So student loans are just not that profitable for them. As interest rates fall would be where it really gets interesting. Because if their cost of funding, lowers, and the coupon rate that they could actually offer these student loans at stays very similar to where it is today, the book will open right up. So honestly, that's another lever though. Like that's the interesting thing about banking is like as interest rates are rising, personal loans just took over the whole book because credit card rates are at 21.5% on average, $1.3 trillion of a total addressable market. And they're saying, hey, we can lower that 21.5 and give you 14. Sound good? People go, wow, that's great. But it's 14%. Like it's still incredibly high. Whereas student loans, you can go, hey, we can give you this to you for 7%. And people are going, I'm paying 6.5. Yeah, but we'll extend it over 20 years. Okay, fine. Like it's not as great. I think that's the only downside.
Yeah, no, the banking system is set up pretty well. Like the more, because I used to be a JP Morgan investor, in JP Morgan stock, and the more I really dove into that company, the more I realized one thing all of a sudden going one way, all of a sudden helps some other business. While you think you're hurt this way, but something else has helped, and then the flip side, something could be hurt that's helped. It's amazing how actually well the banking system's set up when you really look at it. It doesn't mean all banks are well run, but in terms of the banking system and like the Fed raises rates, certain things are helped. Like let's say savings accounts. All of a sudden, Fed raises rates to 5+%. All of a sudden savings accounts, a lot more people are interested, or treasuries and other things, like lending might be hurt. So it's fascinating how it works.
What's a great read to understand this is you go back and read the analyst reports for SoFi back whenever student loans were getting taken away, okay, and interest rates were climbing. People said SoFi's dead in the water because their main business is going away. But then they pivoted to personal loans, and those were the biggest benefactors of higher interest rates. Now, as interest rates are coming down, read the analyst reports now. They don't talk about the benefits to student loans or home loans or our invest products or credit cards or any of these things. They say, well, personal loans are going to get hurt. Why don't you talk about the other side of the business that's actually going to do well? You know what I mean? Like, so that's the only thing. I mean, if you have a fully diversified suite of products, you have half your products that do well in lower interest rate environments and half your products that do well in higher interest rate environments. And that's just how it works. And the diversification leads to benefits in all, all areas. And especially because they're so, not a mature company, that you don't really have a lot of these long-standing loans that could potentially be risks. Like if there is, I don't want to get too technical, but you're seeing some of these companies, some regional banks fall into larger pressures because the bank term funding program is now getting taken away on March 11th, which means that banks will have less access to liquidity in case that they need it for some pretty expensive loans that they have to fund. And people are going, well, how's this going to impact SoFi? It's like SoFi doesn't have the same problems because they don't have that large of a loan book that is, from a much, much lower interest rate environment where the coupon rate or the interest rate that people are making is much lower. So I actually think that they'll be good benefactors if there's another run.
One of the things that I just thought of while you were speaking there is the SoFi investor base has always faced so many questions of like, well, this, that. I feel like it's probably the shareholder base in the banking related space or whatever you want to, that's had to think about all these different things the most, because they don't get the pass that the traditional banks get in terms of just like, oh, they're big, they're well established, they're on all the corners, whatever. And it's SoFi, it's like, you buy that stock, you've got to think about this angle and that angle and this angle, and so I just feel like the community is really a very educated community. Let's say compared to pretty much probably any other bank related company you want to put them against.
That's our alpha. Find a company that you spend too much research on because other people aren't willing to do it, I guess.
100%. And it ends up benefiting you in the end because you understand it inside and out, and it gets you through those tough moments of the stock not doing well.
Oh my gosh. I mean, the feeling difference between, waking up in the morning of SoFi earnings, pre-earnings, and how I felt, I was just excited. I was like, I can't wait for them to beat, triple beat, because and the day that they miss it, I'll have to change my frame of reference, but it hasn't come yet, So, versus whenever I go to PayPal, I'm going, you know what? On a hope and a prayer, let's just hope that they reverse, because things have been falling apart. So people have been used to getting beat up. I don't know. It's a different feeling.
100%. Yeah. 100%.
Oh, go ahead. I was just going to pivot just because I also want to get into some PayPal news, but I wanted to ask you just a couple last questions about SoFi.
Yep.
During the 2026 guidance that they put out, which a lot of analysts are just saying that this is, good aspirations, but not actually achievable. And that has actually been written in multiple analyst reports. They do not think it's achievable. That being said, SoFi is guiding for 55 cents to 80 cents EPS in 2026. And they said that's without adding small to mid-sized business banking, any small mid-sized business lending, like going after, mom and pop shops, these sorts of things. That doesn't include them getting into insurance or asset management or expanding geographically to potentially LATAM or anything like this. What do you think? Have you thought about any of their future aspects of the company and what you would like them to get into next?
I think, so first off, the 55 cents to 80 cents, I think that's possible as long as there's no big recession between now and then, right? Sure. If there's a recession that, throw all those numbers out of the wall, but if we just have a decent economy, I'm not even talking about a great economy, a decent economy for the next couple of years, there's no doubt, seeing the turn in the income statement over the last 2 years, there's no doubt that I think they can get to 55 to 80 cents. But when I think about it, I'm just like, I trust Noto so much. He's done so phenomenal, like building this business, and from just like a student loan company, which they used to be categorized as you framed, to what they are now. I think he needs to just keep executing, and I fully trust wherever he wants to take this company. And I think he's going to continue to grow the business, but I think he's going to do it relatively conservatively, based upon his tonality on the conference call. Even seeing he did a CNBC or Bloomberg interview in the past, couple of weeks, like seeing his tonality, I like everything they're doing. I think just keep expanding products, keep expanding customers, keep acquiring customers, it's like an Apple situation. Get somebody through your ecosystem, however, if it's AirPods or if it's an iPhone or an iPad. And that's why you look at SoFi. They offer so many different products. Get somebody in the ecosystem, and then we can sell them another product. And then we'll, and the holy grail always to me is getting that checking account. If somebody's
Yeah,
got a checking account, direct deposit, that's the holy grail, because I feel like then it's just so easy to build off that. So I love the direction the company's in. There's nothing specific that sticks out to me like saying you need to do this or do that. Because also when it comes to the banking space, I just don't feel like I have a great enough insight to be like, we need to go after this market or that market. It's
sure,
not one of my highest, I used to say, competencies levels compared to like restaurant business or retailers or things like that. So
sure,
I have
sure.
full trust that Noto knows what he's doing, and he's going to lead the company in the best direction that is possible. So
Yeah, yeah. No, I'm pretty excited, and I think just to add one more comment because maybe you hadn't heard this, so I'll just I wanted to tell you this as well. One of the things that has been extremely important for SoFi investors, and maybe I can bring up a chart really quick. It's not going to have Q4 numbers in it, just because we haven't actually. Oh, actually, I might not be able to show it. My chart's all out of whack.
that's fine.
Anyway, essentially, there's a little thing called risk-based capital requirements that SoFi needs to get to, or well, stay above. SoFi was falling off a cliff, and I guess the thing or the problem with being a chartered bank is that you don't have as much flexibility with how your funding is, or flexibility that a tech company could have, or restaurant. Like you can be as crazy as you want because it's not people's money that's on the line like it would be customer deposits.
Mm-hmm.
So SoFi has to play a particular game. That number, quarter after quarter after quarter, was getting extremely close to the danger zone. Okay. It was 14.5%. They really can't get anywhere near 12.5. And just to say, like, 2 years ago, it was like 25%, or a year ago, it was like 25%. So
it's just for everybody watching. This is a number that the government would step in and say, no, you can't. You got to back off your business.
Yeah.
You need to raise, your capital requirements and those sorts of things, right?
Exactly. So, SoFi, by the way, in Q4 did turn that around. The number's starting to improve, but it's also a risk that lending might have to slow, just like from a regulation perspective. And so people are really, sort of blowing the horn on that concern. Now, there's a couple ways to get away from this regulation. One, you can grow your risk-based assets, so then the percentage that you have loaned against it just essentially goes down because you have more, or goes up because you have more. So become a bigger company, grow your tangible book value, that sort of stuff. They're doing that. Two, you can end up having your customers pay off your loans quicker, so it gets rid of that risk. They're also doing that, right? There's like $8 billion of loans get paid annually or something along these lines. But three, and the most important, is selling loans. This has been like the number one thing for SoFi. You need to track how many loans that they're selling. It's the most important metric right now. A firm just came out and said they have been selling loans through Q1. So they give forward guidance on how they're selling loans right now. And they said things are looking unbelievably positive right now. And it's not just good for us, it's good for everyone in the ABS markets. And that includes SoFi. So just a little tidbit there, maybe on some forward guidance that SoFi is also potentially having a really good market to sell loans in Q1.
I wonder who's buying those loans.
So asset managers, the BlackRocks of the world, and Vanguards and these sorts of things that are selling fixed income products. Not really banks. That's the problem. Banks are not really touching it.
Yeah, it's just then it's going to be those guys that are really taking the risk in the end and potentially holding the bag if things go south.
Yeah,
so,
or reaping the benefits of if people that are paying their loans back. But
yes, yeah. Interesting.
So essentially, they're saying that the market for selling loans is increasing. That's going to add a ton of, or help alleviate a lot of pressure off of SoFi. So let's move on. Let's talk about a little bit of PayPal.
Sweet.
So PayPal, a growing position. However, I haven't put any money in PayPal after earnings. I wonder for you, but this position was growing for quite a while in my portfolio. Sort of a turnaround play. Priced as a value stock, but actually I'm looking at it as a potential growth stock. What are your first thoughts with PayPal's Q4 earnings?
Loved it.
I
Loved
don't
it.
even know
Loved
if
it.
me and you have spent any time talking about Alex Chris either.
Yeah, I'm trying to remember. I can't remember if last time we spoke if he was on the team or not.
Gotcha.
But yeah, let me first. I gave this illustration in a video I did recently in regards to kind of my view of PayPal,
Sure.
and I showed like one of those epic Royal Caribbean cruise ships, right? And I said, this is what Alex Chris has come into here at PayPal. It's like this unbelievable ship, but the ship, isn't quite moving as fast as it could. People are kind of a little impatient with it. Like, we need to move this ship faster. Like, and so Alex Chris has come in and he gets this beautiful ship. It's not broken. It's not the Titanic. It's not cracked in half and leaking. It's just like this beautiful ship that he's got to get moving this thing in the right direction and moving it at speed, right? And so that's the way I view PayPal, to put kind of a mental image in everybody's head. Because there's a lot of CEOs that come into companies and they are like the Titanic. They're just broken companies. This is, a bit of broken stock, in my opinion. So the results are really good in terms of this past quarter, right? 9% revenue growth, 15% total payment volume growth. I believe it was 39% operating income growth, and then it was something like, I think, 61% EPS growth or something like that, right? I mean, anybody that knows anything about income statements, it's hard to argue like those are bad numbers. Those are phenomenal numbers. Like, if you could put up those numbers, you're doing well for yourself. Non-GAAP numbers were all very impressive as well.
Yet the stock crashed right after earnings.
Yeah, 11%, and then it came back a bit. But I had a lot of concerns going into the earnings, not about the numbers, and I did a full video before the earnings came out. And I said, I'm not worried about the numbers. I'm not worried about the conference call. The thing that's worried about me is a lot of retail monies in PayPal.
Sure.
Not all retail. Some retail is very sophisticated, right? And we know some of those folks. I've met some, many in the years in my private group. I'm sure you met many in your community that are, my gosh, they're way more intelligent than most people on Wall Street, right? But a huge percentage of retail is not those people, right? It is very, they don't understand too much. They don't even really understand like an income statement or a forward P or just base level stuff, to be honest. And so those people are very easy to get scared. They see a stock going down and they're, out of that stock. And so it just sells, breeds kind of more selling pressure. And I looked at X, X is a good gauge for kind of sentiment on, what communities are. It was so bullish going into the earnings. So many people were so excited about, the stock going up. So many people playing options on PayPal. That can screw up a stock big time if the stock isn't moving the way you want it to move, right? So there's so many various factors that I think held back the stock. And everybody thought the conference call was horrible. To me, I didn't think the conference call was horrible at all. I thought there was a management team calling it how it is. I think there was an Alex Chris who described the numbers as solid 3 times, which means he has bigger ambitions for PayPal than where they're at right now. If he's just calling this quarter a solid quarter, I think 50% total payment volume growth, 9% revenue, 39% operating income is pretty dang good on a GAAP basis. But to him, that's just solid. So I don't know. Like, there's just, and then I saw the sentiment after, a lot of negative sentiment after. He should have said this, he should have said that. People wanted him to pump the stock, I guess. It's just like, that's clear to me. It's inexperienced people in the stock, a good amount of inexperienced people, and also a good amount of people that just want the stock to go up in the short term, probably because they're playing call options or they're short-term traders. They're not actually investors. So my hope is we've kind of got a flush out of those people. Those people kind of gave up on it, and we can go up from here, and it's just a long-term shareholder base. That's my hope.
So I specifically did not watch any of your, content on PayPal after earnings because I knew that we were going to have this call.
Yeah.
So have you added to your position? How are you playing this?
Yeah, I added. Let's see, that would have been, was that yesterday or Thursday? I'm trying to think. I think it was Thursday. I added like $50,000 worth, or a little under $50,000 worth of the stock. So added up, pretty aggressively. And my plan is to continue to add some shares. The problem is I got several other stocks I'm also buying right now. But my plan is to add some more shares. I'm probably not done buying PayPal. I think, my thing is the risk reward is just so darn attractive. We're trading at bank valuations, like big bank valuations now, in terms of like that 10, 11, 12 range, in terms of PE ratios. And I'm just like, I do not view PayPal as a big bank. I just think it's so much of a faster growth company and has so much more of an exciting future than it's being given right now. And so therefore, I'm still a buyer of the stock, and I don't plan to stop buying it really anytime soon until I see something. If I see the business model is broken, that's going to change my opinion. But right now, it's hard to argue against those numbers. The numbers are very, very impressive.
So I was one of the people that was quite negative after earnings. I haven't sold, haven't done anything. I'm holding this position, not adding. I saw the numbers. Transaction margins inflected, which was the biggest thing that people wanted to see. Take rates, transaction take rates, total take rates, a transaction and credit loss rates went down, all positive, like unbelievable quarter. It was great. That's not the problem that I had with PayPal. My problem was every decision that management did during that quarter, so the numbers are concrete. There's no opinions on the margins and all these things. What is an opinion is the way that they portrayed guidance. What was an opinion or management's decision was what they did with buybacks. I thought that was really silly. What they guided for buybacks. So essentially, PayPal has been doing $1.5 billion of buybacks every quarter. And then the first quarter that Alex Chris gets in, they did 600 million. Well, the stock is like near its all-time lows. And I thought, that's so silly. We should be buying aggressively if, like, you're sitting on $14 billion in cash and short-term investments. And not even the majority of that is in short-term investments, by the way.
Yeah.
Like, what are we trying to do with this cash? I mean, yes, we're going to be a growth company, and they spoke about that. But,
yeah. So let me attack that one, and then we can kind of keep going further here. But
sure.
My opinion on that is, I think Alex Chris probably came in and wanted to really overlook the business in detail. And so I think he really wanted to get a good gauge on, should we really be spending a fortune on buybacks this quarter? And I think he took a look around. He realized, okay, I think we need to lay off or fire, however you want to put it, about 9% of the workforce. I think this is probably what we're going to be able to bring in over the coming years. And I think he got a good gauge now. So I'm expecting a huge uptick in terms of the amount of shares bought back, obviously over the next 3 quarters specifically. But I'm not as concerned about that personally, because like I said, you're a new CEO coming in. You probably want to have everything chill out a little bit. And let's not have all this money go out the door right now. Let me make sure where our growth vectors is. How much money do we need to have, funnel into this business that's not bringing us income right now, or this business or that business. So that's kind of my opinion. I think in terms of that,
I agree with you. This company is unbelievably cheap. Like the PEG ratio is not under 1x, it's under 0.5x. I think it's like 0.49 or something based on analyst expectations. Forward PE is 11.5 or something like this. Unbelievably cheap. Love it. It's trading like a tobacco company, as Stephen Fiorillo likes to say. I think that's such a great comparison, because it's like, okay, one has a market that is shrinking and payments is not going anywhere. Like, it's increasing dramatically every year. But I also think that if you're trying to turn around this large freaking cruise ship of a company, you can't make small steps. And I do think that people know that PayPal's market share is shrinking to the likes of Apple Pay. They're losing large platforms like Shopify to, their internal, Shopify payments, these sorts of things. So around them, they're kind of seeing these problems. And yet the way that I would look at that is that you need to be aggressive right now to turn the ship around, and you can't take it slow. So I looked at Elon Musk getting into Twitter and firing 75% of the staff.
Yeah.
And, I don't think that PayPal should probably do a 75% cut, but I think that you probably could have laid off 18% and nothing would have changed. You know what I mean? Like, I think these small movements is not what people are like. I think they're being conservative on the buybacks. They're being conservative on just all of their aspirations. And if you are sandbagging guidance, that's not, you need to sell the picture that this is a growth company going forward. Not that, so I agree with you, numbers speak everything, but I do also think it's the CEO's job to excite investors for the future. And in this it's not a legacy payments company, but in the older style payment company that PayPal is, you need to reinvigorate people that change is coming. And talking about fast lane or, increased checkout is not the only thing that I think is important. I don't know.
Okay, yeah, let me push back against that a little
Yeah.
bit, right? Because here's Alex Chris 3 weeks ago says we're going to come in and shock the world, and
Yeah.
he gets destroyed because of that, right? Like, oh my gosh, who says that? He's going to shock the world. Oh, he's trying to pump the stock. And so I think he's got to find a fine balance here of maybe something in between. We're going to shock the world, and let's all go into depression. Somewhere in the between.
I completely agree. I think shock the world is fine. Is fine commentary if you're going to shock the world.
Yeah.
So I think that it's based on his what you're delivering. If you're revolutionizing commerce and your biggest product is that you're bringing a Face ID to allow for faster transactions, it's like you're just catching up to the competition. That's not revolutionizing commerce. That you're saying Apple Pay revolutionized commerce. You're doing something that's already been done. Should have been a standard for a while. So, and also I was, even whenever we like live streamed that 6 innovations video that PayPal did. I said this is probably not going to be unbelievable. I think expectations got way too out of hand. It's payments. They're not coming out with a brand new EV. Like, there's not too many new things to do. It's just about getting total payment volume up. Like, increase conversions, increase authorization rates, and try to take the highest take rate you can. That's payments.
Yep.
And so, I don't know. It was a bold choice, and I think that he scaled that down, but a little bit too far.
Yeah, that's fair. And that's probably fair. The man's got obviously a lot of executive experience and has been incredibly successful, but this is his first time obviously being a CEO of a public company. And I think there's going to be a fine balance of kind of figuring out, how to make the investor base very confident in your future, but without being a pumpy, because, and I love Palantir. We know I'm a Palantir investor, but, I'll put Carp more into the pumpy category, right? Carp's a little bit more of a pumper, he's we're the best. We do that, that's just Carp. He's very arrogant, very cocky, and not every CEO's got to be like that, right?
But potentially a product to back it up,
Yeah. So I don't know, man. But anyways, I like where everything's headed. I like the conference call. I even like the CFO. And once again, she sounds very depressing if you listen to her. But I mean, I don't know. Like, I just kind of eat that stuff up. I like the realness. I like the, they view PayPal as not being in a good place. It's clear. It is clear when Alex Chris is talking and when the CFO, they describe PayPal as they want to get this company in a way better place than it's at. And I'm like, I don't know. I just don't see a company that's really in that bad of a place. If their total payment volume is going down, like negative, right? If their revenue is negative, if their EPS is, then I understand, like, oh crap, man, we're in trouble. But the fact that they take it so serious and they think this company is doing so bad, and I don't know, I appreciate that, because I'm just thinking about, where's this company going to be 2, 3, 4 years from now if they think this is not good and this is not acceptable, and we're gonna. So I don't know, we'll see, but that's pretty interesting.
I'm continuing to hold, right? I think that same thing with SoFi. Management can say one thing and do all these things. I think that the focus should be put on the actual numbers. And this quarter was excellent. Like, all of the things that I wanted to see were checked off. I'm happy. I continue to hold, but I'm not buying right now because I do think that part of, like, I don't think that numbers are alone. You also need to have some great CEO experience, and maybe Alex Chris needs to build into that, right?
Yeah.
That's another thing. Like, I saw Brad Gerstner from Altimeter Capital actually ended up buying a small stake in PayPal, and he said, we're looking for management teams that are trying to be amazing. There's deals all over the stock market. So if Alex Chris in any way, like if he sees any sort of weakness or maybe too slow to change, they're not going to waste the opportunity cost on sitting on this company waiting for it to turn around because there's better deals out there.
Yep.
And so I think I'm thinking the same thing. I'm going to give him 2 solid quarters to potentially figure out where they want to go with this company, but at a quicker rate. Like,
let me say one other thing, okay? And I think this is I think there was a lot of things that were just lost on people, and I just don't think enough people have been in business long enough for investing to think like common sense, okay? Alex Chris just laid off 9% of the workforce.
Mm-hmm.
Who's listening to the conference calls? It's not just investors, it's a lot of employees, right? Do you want to hear, oh, everything's so amazing at PayPal, oh, we're doing so amazing, when you just laid off 9% of your workforce?
Mm-hmm.
No, you need to sound more downbeat. Otherwise, your workforce is like, really, things are so amazing. Why 9%? Why did my buddy just get laid off if things are that amazing? You need to sound like, we've got a lot of work to do. We got a lot of work ahead of ourselves. Even if the numbers were actually, once again, in my opinion, great, you need to sound more downbeat. Otherwise, people are like, what the hell? Why we just fire all these people? And 9% at a company like PayPal is not a small amount. There's a good probability if you work at PayPal, you have a friend, a colleague, somebody you worked with that got canned. And so you can't come out and make everything sound amazing. No different than when Zuckerberg did the big layoff, right? I think he was crying on the stream or whatever. It's just like, you can't come out and sound like everything's amazing at that time. You kind of got to be a little more downbeat. This is a tough decision, man. I didn't want to have to do this.
Right.
I don't know. I think that's another thing. You just did the big layoff. So anyways, I just don't think enough people pay attention to these things that are very important. But anyways,
Yeah. I honestly, I think that earnings call just came down to guidance. That I think people are expecting higher full year EPS. I think that stock-based compensation for PayPal is not necessarily high, but for the maturity of their company, it's pretty freaking high. And
that's why they want to add back in SBC to the non-GAAP numbers, which I don't think people like in the short term, but I think that's a great decision long term. I think that's a lot of transparency because you could hide that or you can add that back in. I love that.
No, but I think that went past a lot of people at first. I think they just took the number and looked at it and said that's low. Whereas no, they're actually adding in a lot more adjustments than before, right? So it actually looks lower because they're being more stringent. So I agree with that too. I think that maybe could have been addressed better. Like I just think they're early but I just don't want to sit around too long to watch Alex Chris become the CEO that he needs to be whenever I can invest in companies where they have, excellent management right now.
Yeah, and that's fair. And my other opinion also on the conference call is my thinking is if that stock was 70 something dollars after hours, I think people would have thought the conference call was great. I think so much of stock price, and I'm not saying with you personally, by the way, I'm just saying of retail in general. I think when the stock's going down, and it was already going down way before the conference call started, right? The stock was already tanking into the 50s, I believe, or like, maybe 61, 60. But I think when the stock price is going down already, and then the conference call doesn't revive it, and it even goes down a little more, I just think it sends us a big negative sentiment. But there's also conspiracy theory out there, right? There's conspiracy theories with SoFi and PayPal. This conspiracy theory is, and it might hold some weight, but it's that management wanted to lowball numbers for a couple of reasons. One is obviously you want to come in and beat numbers throughout the quarter, right? You don't want to be a brand new CEO and you're missing your numbers. It's embarrassing. And, you're going to lose more trust than ever. But the second component is if you're going to do $5 billion plus of buybacks, we're talking about this such a substantial number that, do you really want the stock to be at a much higher price right now? You might not. Because you can buy a lot more shares back if the stock's at 58 than at 108 or at 98. So I don't know that it might be nothing there, but maybe there is a little conspiracy theory. I don't know. We'll never know, obviously. But
yeah, I mean, I agree with that. I think that potentially for Q4, I just maybe wish that they had stayed on pace and not lowered buybacks. But there's the opportunity to sort of show that they did say at least 5 billion. I hope that they pass that number. I hope that they come in Q1 with at least a trajectory that might show that they're going to do more than 5. and then they can scale it back if the stock price increases faster than they think. But I don't know. I do agree that the call can seem worse as stock price is going down. What I thought was kind of a little bit silly was most questions that they were asking him about what they were expecting to do going forward and all of these different innovations and how they plan to take market share and all this stuff. He kept bringing up these 6 innovations: fast lane, increased checkout, smart receipts, yada, yada, yada. And it was brought up, I think, like 4 or 5 different times, these different products that they're coming out with. And I don't know. I just felt like it was the chief product officer was leading the charge rather than saying that more cuts needed to happen, which sucks. But I mean, I think investors really look at companies like Adyen and they see them have 3,000-4,000 employees and they're doing a third of the volume that PayPal is doing. And yet they're saying they're done hiring. So they're going to continue to scale everything like this. And yet PayPal cannot get away with, 1.4 trillion, and they need 30,000 employees to run that. It's just, maybe companies bloat as they get bigger. And I think that there should have been a larger cut. Maybe
there's more cuts coming that we don't know about yet. That's another potential. Meta did, if I recall, Meta did several cuts. They did the huge one. Amazon's done several cuts. They did several cuts, right? So I don't know. Maybe there is another cut that we haven't seen yet that is coming. I don't know.
And they do need to just follow the playbook of Meta, I think, right here, is that they're beaten down. There's still a large, leader, but people are thinking that the companies that are growing are going to take more market share than maybe what is actually going to happen.
Yeah. And to kind of recap PayPal here, and because I think it's attracted a lot of different investor bases and a lot of different people with different expectations. Some people expect PayPal to become a SoFi, super high growth and those sorts of things. And my thinking on PayPal is I don't need this company to become a big growth company again. If they grow revenue 5 to 10% a year and can buy back 3 to 6% of the shares outstanding, right, each and every year, this is a huge winner chicken dinner. I mean, we're talking about when a stock's trading at 11, 12 forward P or whatever, right? I mean, it doesn't. If they ever get back to double-digit growth, we're off to the races. It's game over at that point in time, right? But I don't need this company to do that for it to be a big success and for it to be a big money maker over the next 3 to 5 years. And so, but different people have different expectations. I understand that. But if you're looking for high growth in fintech, so SoFi's right there. There's that opportunity. If you're looking for valuation play, I think PayPal's there. And it just depends on what type of investor you are and what you're looking for and, those sorts of things. So
I think that the difference is, at least for me, the way I look at it is if you look at tobacco companies or utility companies, energy, all of these ones, very few players, very hard to get into, not an unbelievable amount of innovation in tobacco, right? Maybe some new pouches or something like this, right? But essentially, you can be pretty secure that the people who are smoking will decrease at a very slow rate and people like the brands that they like and the dividends will continue to flow. Fine. Payments is extremely fast growing. New entrants into the space all the time. Market share is being traded at very fast rates. So I don't think it's clear in investors' head that if PayPal, just because they're growing right now, between 5 to 10% ranges, that will be the case even 3 years from now. And so that's why I think that people want change right now, because the clock is ticking. Whereas, Enbridge will be continuing to send oil forever. Well, not forever, but the length of time is a lot longer than potentially PayPal has, and with new entrants in the market all the time. So I don't know.
No, I fully, can understand that point. But the other thing is competition is not new in that space. There's been a lot of competition, and it's fascinating to me because people think everybody's just going to be successful, and it's like you got Apple Pay, for instance, right? Mm-hmm. They force you every single time you set up a device to do Apple Pay, or you have to purposely cancel the button. it's fascinating to me how many, like almost everybody I know owns an iPhone. And it's crazy to me how few people do Apple Pay. And in the past, when I would ask them, hey, can I Apple Pay you? They're like, what is that? They don't even know what it is. Never mind, like have it already set up on their phone versus like Venmo. And it's like, everybody's got it. So I don't know, man. That's the other thing. It's just, there's always a belief that just because a company is a competitor, they're going to take you out. And it doesn't work that way, right? So, even, we can look at a SoFi and you say, how can a SoFi grow? Like what they offer is out there. There's nothing SoFi offers that you can't get other places, right? So how SoFi grow? Well, they do it, right? It's what you call running a business, and you outcompete your other guys, right? And you find arbitrage here and you find arbitrage there. So, I don't know. There's just, I think stock price drives so much sentiment. I think that's what it really is. And if PayPal stock was a lot higher today, if it was $80, I think people would feel very different, or $100. And I think the sentiment on that stock would change so massively. It'd be like Meta, I mean, the sentiment was so trash at the bottom, near 100. I read the YouTube comments at that time, and people were saying it's going to zero. Oh, I'm going to buy when it hits $20. I'm going to buy when it hits $40. I wouldn't, that stock, you're never going to make money. And it's just like, I don't know, man. It's just, it's what comes first, the chicken or the egg. And sometimes I just feel like the stock price is what drives the whole thing. And if the stock price is going up, everybody starts feeling, oh, the numbers are so good, conference call is so good. And then the stock price goes down and everybody's like, this sucks. It all sucks.
Well, so the only place where I think that stock price is very important, at least for PayPal, for companies that need to dilute, it's very important because higher price could lead to higher amount of money that you could receive per share. But in SoFi or in PayPal's case, I think it's important because they're doing large buybacks, and because they're putting real capital towards artificially raising the share price, and it's not raising. People are saying, you're taking money out of the business and deploying it, and it's not working. So you're essentially burning that money. You are lowering the share count, but it's not working. So either
it's a flawed way of thinking, in my opinion, because the numbers are the numbers. At the end of the day, your earnings per share is going to keep going up and up and up as long as your net income's even just flat. Never mind if your net income's increasing while your share count's going down, your EPS just. So, but I understand. And sometimes I even think like maybe I'm missing something here, right? Because I've thought about that plenty of times in the past. I would say 6 months. Like it almost seems too good to be true. That's the thing with PayPal. It almost seems too good to be true that I keep kind of questioning, am I missing? And I also thought that about Meta when I was loading up on that in 22. I was kind of like, damn, maybe I'm missing something.
You weren't wrong there.
Yeah. Thank goodness. But I did have those thoughts several times. Like maybe I'm missing something. Maybe Facebook is done, or maybe, I don't know, like PayPal's the same exact way, the last few months I've been thinking like, maybe I'm missing it. Like maybe Wall Street's right on this. Maybe this stock is screwed. But every time I just like look at it, I'm like, I don't think I'm missing it. We'll know. Well, 24 months, 36 months from now, we'll know if we got it wrong on this one, or, we'll see.
Sure.
So.
Yeah, no, absolutely. Like I said, I'm still a shareholder, but I am also, even with SoFi, a bunch of people in the community, I'd probably say I'm one of the larger proponents for SoFi on YouTube. And yet people still call me the bear of the community. It's like, I just want to be ultra critical about my positions because it's my money at the end of the day. I'm not just trying to spew content. This is my portfolio, So yeah. But Jeremy, let's wrap there. I really do appreciate your time. This was, an excellent time. And I think actually the last time we spoke, I just remembered, was on a Mitts channel. We had that massive fintech junkies, if you remember that.
I do remember that. Yeah. So maybe the last time I was on your channel might have been maybe like 6 months ago. Maybe it was a couple quarters ago.
Yeah, maybe. Well, happy to have you back.
Well, thanks for having me, and look forward to hopefully us doing this again, maybe another 3-6 months, and hopefully, maybe PayPal's kicked into gear a little bit at that time.
Exactly.
SoFi, I got to be honest, SoFi, I'm kind of hoping it stays in a lower place because I would like to buy this over the next 3 to 6 months.
Build a position.
Yeah, so I'm sorry for the SoFi shareholders out there. I'm kind of rooting for the stock to not do well in the short term here, but
Yeah. Well, they should be, like management is guiding for, consistent GAAP profitability. So hopefully you get exactly what you want. And which actually might actually be wrong, because if they are doing that, you might not get a cheaper share price, but you're getting the stock that you had previously wanted.
True, 100%, 100%.
Ladies and gentlemen, if you guys don't know Jeremy Lefebvre, you can check him out. I'm going to have his links down below, as well as I'll put your X as well. I don't know if there's other platforms. I know you've been streaming on Twitch a lot.
Yeah, no, X and Instagram, that's probably sufficient. So
perfect.
yeah.
Perfect.